Hi everyone, I'm Prateek Nigurkar from the quantitative team at DSP Asset Managers, and today I'm going to take you through the important aspects of the DSP Multi-Asset Allocation Fund. How does mixing of elements help? Sometimes results that science produces is nothing short of magic. Alchemy from its past history has always had this magic, that aura around it, even though it is just application of basic chemistry. It's just that the results are so spectacular that people equate it with magic. Now, having studied chemistry in college, I still find it hard to believe that something as simple as aluminum foil, which you use to pack your lunch, essentially, with just the addition of certain more elements in just the right proportions, can actually turn it into an airline part, something that is able to withstand extreme pressure and extreme temperature. This again, to me, is nothing short of magical, because small changes can actually change the chemistry such that it vastly changes the properties of a certain element. Fortunately, the same is applicable in investing as well. But before we go there, it's important to sort of dispel an important myth. Uh, that if you were to do diversify in the same asset class, uh, it sort of leads to better outcome, which we'll talk about as to why that is not the case. So let's talk about it. Uh, there is a lot of myth around the fact that if you were to have diversity in terms of within the same asset class, let's say if you're just diversifying within equities, you have about 50% in large caps, 25% in mid cap, and about 25% in small cap. Uh, there's this feeling that you're diversified. Uh, Nothing can be further from the truth. If you look at the example of, let's say, a year like 20 or 2008, which had the financial crisis, a year that was markedly very, very bad for equities. No amount of diversification within the same asset class, if you were to do it across, mid cap, small cap, or large caps, it would have helped you. Same is the case if you were to be diversified across, let's say, factors. You had a low volatility factor. If you had a value in your portfolio, that wouldn't have helped either. The portfolio would have fallen in most cases almost as much as the broad equity indices. Same is the case in, let's say, COVID, where markets again saw a very sharp correction in a matter of 3 weeks. And no amount of diversification within the same asset class would have probably helped. Uh, Also, there is this myth around the fact that if you were to add a defensive sector uh, within the asset mix in equity, it would probably rid you of large drawdowns. Again, it doesn't really support. It's not really supported with the data. Even if you were to add defensive sectors such as pharmaceuticals or FMCG, you would have had an outcome which was fairly extreme in terms of drawdowns, both in 2008 and 2020, years that were marked with very, very sharp equity market corrections. Um, the average actively managed equity fund did not do well either. So it's important to understand what leads to diversification, right? What we've seen just now is that diversity within the same asset class doesn't really help. And why is that the reason? It's because you're buying the same kind of underlying. So if you were to look at a correlation matrix, for instance, between a large cap fund and a mid cap and a small cap fund, you see very, very high correlations, which means essentially you're drawing from the same set of companies, the same kind of cash flows, which are very, very correlated to an economic underlying fundamental. Uh, if you were to look at a correlation matrix, let's say, uh, within different kinds of factor portfolios, you will probably find that the correlations there are very, very high. there as well, anywhere ranging from zero point 0.9, and in some cases it's perfectly correlated to a broad index, again to highlight the fact that uh, it's sort of not exactly diversifying in a true sense if you're diversifying within the same asset class. And that's why you need more asset classes in the mix if you were to aim for true diversification. This is how a truly diversified portfolio is created. It's when you mix asset classes that are truly uncorrelated, that are truly negatively correlated. This is again just an illustration. If you were to look at the long-term correlations between, let's say, Indian equity, Indian fixed income, gold, and international securities, you find that the numbers there are much lower than you saw in the previous slide, where they were in excess of 0.9, 0.8%. What this does essentially is to give you that robustness that, when one part of the portfolio is not working, the other one is firing. Right. So this gives again robustness to the portfolio. It gives that anti-fragility uh, color to your portfolio if you were to do it this way. What is the kind of evidence, if you were to look at the same two exact periods where we saw that diversifying within the asset class doesn't really help. If you were to do it across asset classes, however, there's a market difference in terms of the outcome. Here again, the chart on the left, you see the financial crisis, where the Nifty fell, upwards of 50% for the year 2008. If you were to have a mix of a multi-class, a multi-asset portfolio, which would be 50% equity, 25% fixed income or debt, and about 25% gold, the outcome would have been markedly different. And that also shows up in the numbers, where a Nifty 50, for instance, fell about 59% from peak to trough, whereas this kind of mix would have only fallen by about half. And that would have saved you from a lot of heartburn and sort of not derail your long-term financial goals if you were to have done it this way. If you were to take the case of COVID again, the magic of multi-asset diversification again shines brightly, where you see this kind of mix again would have fallen less than half of a pure equity portfolio. Again, highlighting the fact that true diversification can only come by combining different asset classes, not be diversified within the same asset class via different market cap buckets or factors within equities. How does multi-asset allocation work in the global context? If you look at the slide here again, uh, you know most of these countries, countries like Pakistan, for instance, is going through political turmoil. Domestic equity returns have been poor. Greece again has had its fair share of problems in the last decade. Turkey again, there's ongoing political crisis. Japan again is marred with certain set of other problems such as aging and lack of population growth. In all of these cases, again, we see that a multi-asset kind of approach would have done much better than just being invested in domestic equity or just to be invested in domestic fixed income. In India as well, we've been fortunate in this century that we've had stable governments that have lasted their entire tenure. But we weren't so lucky, let's say, in the late 90s, where we saw, different regimes within, sometimes sort of not even completing 1 year. And there are several changes in terms of the political dispensation. Equity prices suffered in the process. You also had your Asian financial crisis. All this sort of takes a toll on equity prices. Again, in periods of turmoil, if you were to have a right mix of different asset classes, your outcome would have been much better. Not just in countries where there is political turmoil, even in stable countries, stably slowly growing countries such as the US, China, or UK, for instance, a multi-asset allocation framework almost always is actually better from a risk reward standpoint or risk return standpoint in most cases. Now, it's important to understand, what do you make of, uh, Indian equities and Indian growth story, and a lot of narrative that is floating around. Of course, we are in a better spot than most other countries. Of course, we would expect our equity markets to be vibrant and deliver, good returns in the coming decades and coming centuries also. Uh, what, however, is sort of not clear is that all of this would be linear. If you look at the chart on the left, what we've seen is that market returns have largely been in tandem with the kind of GDP or nominal GDP growth rates that India has enjoyed over the last 20, 30 years. Uh, the problem here is that while over the long term you would expect returns to sort of closely be aligned to the kind of GDP growth, nominal GDP growth that you were expecting, uh, it's not always linear. So it doesn't follow every year the same way. So between 93 and 2002, for instance, the period that I just spoke of, where India had several governments and you had political turmoil, you also had Asian financial crisis. There was a period of 9 years where there was next to zero equity returns, even though the economy did manage to grow somehow. Equity returns did not come about. Again, if you were invested in just equity as an asset class in this period, you would have possibly had a harrowing time, because 9 years without any returns is a very, very long time, enough to frustrate most investors and dump the asset class altogether. A multi-asset framework, um, on the other hand, would help you stay put and not sort of give up on the journey of wealth creation and achieving your financial goals. Uh, 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 there was another 6 year period that was marred by the financial crisis, the global financial crisis, where again the returns between 2007 and 2013 were next to nothing from equity as an asset class, and yet the economy actually did chug along. So again, a period where a multi-asset framework would have helped you stay the course and not deviate, from what you want to ultimately achieve by investing. Uh, a multi-asset framework also obviously makes a lot of sense if you were to invest uh, during times when equity valuations are very, very rich and very, very demanding. Like for instance, right now, where by most metrics you would find that equity valuations are at or equities are trading at very, very rich valuations. Uh, our analysis suggests that whenever you were to invest in a multi-asset kind of framework during this kind of period, the outcomes are actually better over the medium term, over the next 5-10 years, than just investing in equities. When the markets are, of course, cheap, you would want to invest more in equities. But periods like now, where we are trading at very, very demanding valuations, it would actually make a lot of sense to be invested, not just in equity but other asset classes as well, in the right mix, to sort of to have a better outcome over the medium term. Again, we're trading at very, very close to 52-week highs. The chart on the left again illustrates the point that during around market highs, if you were to invest in a multi-asset kind of framework, it actually delivers better returns than a full equity product over the medium term. Again, why it is important to be cognizant of what's going on in equity, not be sold on a long-term equity narrative that has sort of gripped the financial news right now. Uh, the best part about asset allocation, of course, is the fact that uh, you know no matter which asset class does well for a given year, you will always be invested, or some part of your portfolio will always be invested in the asset class that does the best. Whether it is gold, let's say in 2011, or it is or equities in a year like 2009. You'll always be investing in some proportion in the asset class that has done the best in that particular year. So you are sure to get the upside from that. In terms of mixing allocation, let's say if you had perfect hindsight, if you had perfect hindsight and you would pick at the start of the year the asset class that is going to do the best that year. In that case, versus 13, let's say close to 13% in equities, your outcome would have been 28.7%, right? So that is with perfect hindsight. Now, of course, nobody is God, and perfect hindsight is only a mythical portfolio that nobody can achieve. What you can do, however, is to split your money equally across these four asset classes. Domestic equity, domestic fixed income, international equity, and gold. If you were just to do that in terms of mixing your asset classes, even then the outcome that you would have gotten with an annual rebalance would be about 11%, and you would have been able to do that with much much lower volatility. So already, if you had no insights into which asset class is going to do well, if you were to do just a naive allocation between 25%, 100%, split four ways, 25% to each asset class, that alone is enough to get you to close to equity kind of returns over the full cycle, and it'll get you there with much lower volatility and much lower drawdowns, right? So that is the important point to highlight here. If you want to know more about this concept, please refer to the description, where you have the link to the video where my colleague Devang takes you through the entire thing in much more detail. Again, if you were to do an asset allocation in roughly the proportions that we recommend, uh, the outcome actually is almost as good as a full equity product with half the risk, right? So if you look at the table there, a multi-asset allocation in the mix that we broadly recommend, or where we would broadly sit with the model that we have, which is about 50% in domestic equities, about 15% in Indian fixed income, about 20% in gold, and another 15% in international equities. The kind of outcome that you end up with is again very very close to a full equity product, a product that would invest only entirely in Indian equity, but you would also end up with almost half the risk, which is what the magic part that I spoke of. You don't have to compromise on returns while achieving that in a much much more less riskier manner, or taking on much lesser in terms of risk. Uh, Again, risk does not just manifest itself in the form of lower standard deviation or lower volatility. It also manifests itself in the form of lower drawdown. So if you look at all periods starting this century, uh, periods where equity markets have had a fairly sharp decline, in all of those periods, if you were to follow the kind of asset class that we would recommend, in almost all the cases, the drawdowns are much much more lesser. and thereby, it sort of, if you lose less, what it does is that it keeps you in the game. It keeps you in the compounding game. You're not shut out of a compounding game if you have a large drawdown, early in your investing career. And in investing, longevity is everything. If you're able to compound your returns for a very, very long period of time, that sort of helps, or that goes a long way in achieving your financial goals. That obviously is hindered if you have very large drawdowns, and especially at the start of your investing journey. Uh, Being invested in a multi-asset fund helps you avoid those kind of drawdowns, and helps you be in the game of compounding. So that's very important from our standpoint. Again, there are some insights on taxations. Like I said, my colleague Devang will take you through these in a more nuanced way. Why a debt taxation is probably the best way to go about it if your investing horizon is more than 3 years, and something that we always recommend. The longer investing horizon, the better it is. Uh, Again, why over a DIY kind of approach, do it yourself approach? Because mutual funds are a very, very tax efficient vehicle. uh, you're not really being taxed when you churn out of, or you book profits from an asset class that has done well, and sort of push money into something that hasn't done well. If you were to do it yourself, of course you would be taxed at your marginal tax rate. Whereas in a mutual fund kind of product, you would not be taxed, and thereby over the long term, your the kind of differential in terms of returns that you would expect from a mutual fund, because they're a tax efficient vehicle, will be much substantial. But then again, please refer to the video that Devang, my colleague, has done. He's going to take you through in more in depth about what this is about. Same, equity and debt taxation, about 73% of the times is what we've understood, that over a 3-year period, probably a debt taxation is actually the way to go about it. Again, the longer the horizon, the better it is to be taxed, with debt plus indexation. Uh, a lot of the times, what happens is that uh, because you have that constraint of equity taxation, you end up putting a lot of money in arbitrage products. And what we've seen is that most of the times these arbitrage products are actually inferior in terms of their returns if you were to compare it with a pure fixed income product such as a short-term fund, for instance. So again, you don't give up on returns that are there to be had. It's just because you're trying to solve for a tax kind of constraint, you end up limiting the kind of returns that you would have otherwise gotten through the fixed income side as well. Uh, Coming to the DSP Multi-Asset Allocation Fund, and overview of the asset classes and the stock selection itself. So, like I said, three broad asset classes: equities. Within that, Indian equities, where you would have anywhere between 35 and 70, 80% invested in Indian equities. You would also have international equities uh, in the fund. Debt Indian fixed income, which is expected to be anywhere between 10 and 15% based on what the model suggests. You can also expect to have a sizable allocation to gold here. And also, opportunistically, we would want to be invested in commodities, uh, uh, provided the model sort of throws up in interesting investment opportunities. How is the allocation determined? Again, this is probably the crux of the entire fund, as to what is the kind of model that we're using. Uh, any asset allocation model, for instance, tries to mix the available asset classes, the ones that are that it is allowed to invest in an optimal proportion, right? How do we arrive at that optimal proportion? Basically, there's a model. It is a four-stage model where essentially what you do first is to assess what is the kind of expected returns that each of these asset classes is expected to give you over the next 5 to 10 years over the medium term. Now we fully understand the fact that determining or expecting returns in the short term is absolutely a futile exercise. We know that the markets will humble us all. But having said that, there are ways in which you can broadly gauge the range of returns that you can come to expect from each of these asset classes. So that is where we begin. For equities, for instance, something that you saw at the top of the presentation as well, where equities adjusted for valuations are expected to give you returns that are similar to what the nominal GDP returns are. So if there is a way that you can assess what is the long-term potential GDP growth rate for the economy, it should very well closely tie in, adjusted for valuations again, close to what you would expect from equities as an asset class. That is true for both Indian equities as well as international equities. Coming to debt, again, there's a lot of research around it, but the most important bit is that starting yields are a very good approximation of the kind of returns that you are expected to make over the medium term. So if you start off with higher yields, you're probably expected to make better returns over the whole cycle. If you're starting off with very low yields, something that we've seen across the world, where bond yields 2 years ago were at very low pedestal. And eventually what you saw in year 2022 and partly in 23 as well, where returns from the fixed income portion have been quite poor. So again, starting yields are a very good approximation of what your returns for the entire cycle are going to be. For gold, of course, there is in the absence of a good predictor or a good model that could suggest what the medium term returns are going to be from this kind of asset class. It's best to assume that whatever the long term returns for gold have been is what you can come to expect from this asset class over the medium term, and that is what we take as expected returns from this. Next bit is to assess the volatility of each asset class. Again, going back to returns, higher the expected return, the higher is the possible allocation that you get from that asset class. If an asset class is expected to have poor outcome over the medium term, it is that much less likely to be a large part of the allocation bit. Next is volatility. Higher volatility is of course not desired. So higher the volatility, lower is the allocation to that asset class. How do we assess volatility, expected volatility? Again, volatility has a lot of memory, which means that recent periods of high volatility are often followed by periods of more or higher volatility. And conversely, periods of benign markets or very low volatility are often followed by periods of low volatility again. So the recent realized volatilities are what we use to assess what the expected volatility from each asset class is going to be. And finally, what we do is also look at correlations between each asset class. So let's say, like we saw at the top of the presentation, highly correlated asset classes are not really desired, because then they fail to make the portfolio adequately diversified. What we are trying to look for are asset classes that are truly uncorrelated or have very low correlation, because that is what gives you that invincibility to the portfolio. It helps you become anti-fragile, because if one asset class isn't doing well, the other one is firing, and vice versa. So even if the asset class may not be the best from an expected return standpoint, what we greatly value is that if the asset class is actually having lower correlations and negative correlations with other asset classes in the mix, and that is very, very important for us. Put all of this together with a certain kind of risk profile that we are wanting from this kind of fund, and it will throw up a an optimal mix, which then becomes the mix for the portfolio until we rebalance it for the next time. So all these values are again updated on a regular basis, and whenever there is a large change in terms of the suggested allocation, will the fund also change likewise. Again, this is a very standard mean variance optimization process, something that is well documented and very well researched, and something that has several millions of dollars behind it in terms of AUM as well, globally. So this is a very, very standard process through which people do it. Uh, Next up is, within each asset class, what do you expect to have? So for the Indian piece, you would expect the Indian piece to be a actively managed equity portfolio that you would expect to be diversified not just across sectors but across market caps as well. So it will have a mix of most sectors. We will deploy the portfolio in such a fashion that the underlying equity that we select have a large margin of safety, and something that is, like I said, diversified across all asset classes, but also across market cap, large cap, mid cap, and small cap as well. Uh, Whenever hedging is cheap, we would want to bring in that element again as well, because it makes the portfolio anti-fragile. It makes the portfolio more robust in terms of withstanding large drawdowns. And whenever that kind of opportunity arises, we will also be monetizing those hedges if the markets do fall, and deploying back the proceeds when the markets have become cheap. So again, hedging will be part of the equity strategy. We've also enabled covered calls as a strategy within equities, so that the stocks that have probably reached their target prices according to us are now fairly valued, or more than fairly valued. We can probably go ahead and write covered calls on part of those holdings to help us enhance the yield of the entire portfolio. So that is also something that we've enabled. International equities, I mean, the core allocation within international equities will be executed through the core allocation to diversified equities will be executed through a basket of ETFs. Satellite allocation, whenever special situations where certainly something pops up, or some country is going through a positive change, we would want to allocate some bit of that to a tactical allocation, and that will be again through country ETFs, for instance. Or if a sector is looking very, very attractive, something material has changed within a sector for the positive, we would probably have a way to gain exposure again via international ETFs. The domestic fixed income part will again be a dynamic allocation between sovereign securities, state development loans, corporate bonds, money market instruments. Again, it will have dynamic duration management, but keeping in mind that it will only have very, very high quality credits, and we will not go down the corporate credit curve, so to speak, to enhance returns. That is something very clear with the fund. For gold, again, we have the option of doing it via ETFs or gold ECTDs, ECT. For gold, again, we have the option of doing it through gold ETFs or gold ETCDs, whichever is the favorable route at that point in time. We would want to gain exposure to gold as an asset class through these two vehicles. Also, for tactical allocations within commodities, we have a list of several of these commodities, which are not limited to things such as silver, crude oil, natural gas, base metals, those sort of things. We would of course employ trend analysis and assess whether the commodity is investable from a tactical perspective or not. We would also be engaged in using commodities. There are a lot of these opportunities within commodities. If you were to look at the term structure of each commodity, there are these opportunities, arbitrage opportunities that arise from time to time, and we would be looking into those as well, and opportunistically allocating some bit of capital to gain higher yield through these kind of strategies as well. Uh, this is sort of the model suggested allocation. Of course, in turbulent times when volatility goes up, the model quickly ratchets down the equity exposure. When the markets become again benign and volatility is on the decline, the kind of equity allocation that you could come to expect from this asset class would from this model would sort of go up. Also, there will be times when the economy is in the doldrums and the expected returns from equity as an asset class become poor. Those would again be times where you have low equity allocation, and as things improve, then probably you would probably see higher allocation along the way. Again, the model is dynamic. It allocates between different asset classes based on what the pecking order essentially is, based on our model and how we assess expected returns from each of these asset class, and is also a function of the kind of volatility the asset class displays, as well as the interaction with other asset classes via the correlation metric that we have. Again, it remains true to label, so it is very agile in terms of and very awake to different market conditions. And again, but having said that, the model will just be a guiding light, and the fund managers, of course, retain full flexibility in terms of deviating from what the model suggested allocations or optimal mixes from time to time. Um, Coming to fund suitability and positioning, who is this fund for, and where do we first position it? Uh, if you were to look at the risk return curve, it would be fair to again put this fund on par broadly with an aggressive hybrid fund, and that's largely down to the fact that under most circumstances, on an average, you would end up with about 50-60% in terms of equities, both domestic and international, and that would line up very close to an aggressive hybrid fund in terms of the whole risk return metric. This, of course, will be more riskier than, let's say, an equity savings fund, where you're limiting the equity exposure to about 40%, and also a regular savings fund where the maximum that you can go possibly in terms of equities is about 20%. It will, of course, have lower risk, like I've always mentioned in this presentation, than a complete equity product. And the endeavor is to have returns as close to full equity products as much as possible by cutting down the risk substantially. Who is this fund suitable for? I would say that while the fund is suitable for everyone, it will be particularly of interest to first time investors, for instance, who are just trying to dip their toes into the market. For investors who want a one-stop shop solution, investors who are not really looking to shop around for funds, who are looking for a more long-term equity kind of returns, but by taking on lower risk. It's certainly very, very good for those guys. It is also meant for seasoned investors who are looking for a thoughtful, a thorough and a more complete solution, multi-asset solution that does provide you, like I said, very close to equity kind of returns, but with lower risk. And it's certainly very, very helpful for retirees, for instance, who wanting to live off the kind of capital appreciation a fund like this would have, but not having to endure debilitating losses in terms of large drawdowns, or wild swings in terms of very, very high volatility that equity as an asset class unfortunately bring with them, even though they are expected to have higher returns. So again, it is kind of suited for everyone in that sense. But certainly, no matter who the investor is, it certainly deserves a large part of your portfolio to be invested this way. That's about it from my side. Thank you very much for listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.